Okay, good evening, guys. Hope all of you are doing well. Okay, so welcome to the third TRG for financial management, right? So we started off with the specimen paper last week. We finished, I think, only the first section B question. So we're done with all the MCQs. We started off the first MTQ and we're done with that as well. So the first MTQ was actually to do with business valuations and cost of capital. Okay, so we went through that. And we left the next one for today because it is a pretty important area. Okay. So what does this area talk about? It talks about risk management. Now, if you really look at your syllabus, the syllabus guide, they will say risk management and they will only say 5%. Okay, so they will say maybe, for example, investment appraisal, they'll say it's 20%, cost of capital maybe 20%. Risk management will be an area where you will say, okay, it's only 5%. Now, the moment you see the 5%, don't get kind of fooled, okay, because what they mean by 5% is it is a small area of the syllabus. There are only 2 chapters, okay, but that doesn't mean it's going to be 5% of your exam paper. Okay, a lot of students think risk management is only 5%. It's a small area. So even if you don't cover it, it's fine. Okay, that's not true. It is small in the sense that in terms of volume, it is small. There are only 2 chapters. One is foreign exchange risk management. The other one is interest rate risk management. Okay, but you are definitely going to find at least 15 marks of your paper focusing on this risk management area. It will either come in an MTQ, it can even come in the constructed response question, and don't be, don't be surprised if you see it in the MCQs as well. So by all means, don't think that it is going to, be a small portion of your paper. It's going to definitely be a big portion of your paper. So what's the issue with this chapter? Okay, a lot of people find problems with risk management, right? The thing is, especially if you haven't gone for lectures recently, you might find it taking a long time for you to learn this chapter, especially when it comes to things like the money market hedge and things like a forward. You might feel like, okay, it's taking a long time for me to process this. Okay, so that could be the reason why a lot of people tend to find this area challenging. But the thing is, after you get it right, okay, after you figure it out, it is actually going to be a set of repetitive questions again and again. Okay, a money market hedge, for example, is very repetitive. If you get the hang of it once, that's all you need. Okay, so first let me just go through those chapters quickly. Okay, because like I said, it is an important area. Let's go through it and then let's look at this Zerona company. Right. So it is actually chapter 17. If you're following the study hub, it falls under chapter 17. Right. So we start off with foreign currency risk. Okay. So the issue with foreign currency risk, it is very straightforward. Okay. Exchange rates, unless you are fixing it. Okay. Now there are 2 types or 3 types of exchange rates you can have. One is you can have a fixed exchange rate. So if you're based in Sri Lanka, maybe in the year 2000, when was that? I think that was around 2015, 16, that period. We had the dollar, it was fixed at about 150 rupees. Okay, that government at that time, they chose to fix the dollar rate at $1 equals to 150 Sri Lankan rupees. So it was fixed. You will never see that rate fluctuating. Okay, so a government, they can decide whether they want to fix the exchange rate like that or whether they want to float it. Float it means you let the supply and demand decide the exchange rate, like how it is right now. Okay, so you can see, for example, the dollar rate, it keeps, suddenly it's decreasing, suddenly it's increasing. Okay, so that is called a floating exchange rate. There is a third type called a crawling peg. That means the government, they can fix the range. For example, let's say the dollar rate today in Sri Lanka, they can fix it saying it should be between 290 rupees and 310 rupees. So it can go anywhere between these 2 figures, but it can't go below 290 or more than 310. Okay, we don't apply that, but some countries, for some currencies, they tend to do that. Okay, so the problem with foreign exchange, the foreign exchange changing from day to day is If you are an importer or an exporter, okay, for example, let's say you are an exporter. Okay, so you are selling goods from your country to a foreign country. Okay, so to put this situation, this is Sri Lanka. Say you're exporting something. What shall we export? Let's export coconut. Okay, nowadays we export a lot of coconut now. So we are exporting coconut to a foreign country. Let's say somebody in China. Okay, now the issue is obviously we can't, use the Sri Lankan rupee as the base of the transaction. Most of the time you will use the US dollar. Okay, so based on today's exchange rate, what will you do? Let's say I expect to get 100,000 rupees from this deal. I want 100,000 rupees. So what will I do? Based on today's exchange rate, I will convert it and give the Chinese guy a price. Okay. So let's just check what today's exchange rate is. Okay. Today it is 200, according to Google, it's 299.86. Okay. So that means $1 will give me 299.86 Sri Lankan rupees. Okay. So if I want 100,000 Sri Lankan rupees, then how much will I have to charge in dollars? You have to divide the two. So 86 now. Yeah. So you will have to charge him $333. Okay. So if he pays you $333, when you convert it, you will get the 1 lakh that you want. No problem so far. Okay. But the issue is you have to understand when it comes to these, when it comes to a foreign transaction, it's not very fast. Okay, because there is a time period that will go at least about 2 to 3 weeks will take, it will take about 2 to 3 weeks for you to finish this transaction. Okay, so in that 3-week period, let's say for some reason, the dollar became 290 rupees. Okay, but you have already quoted the price at 333. So you can't go back on your word and say, no, the dollar has reduced, I want to change the price. Then obviously you're going to lose business, right? So now what has happened, when you get your $333 in hand, when I multiply that 333 into 290, I only end up getting 96,570 rupees. Can you see the problem? I expected 1 lakh. I am getting 96,570. So in case I had, let's say it was a very small margin, only 1,000 rupee profit I was seeing. My cost was itself 99,000. But now what has happened? You're receiving only 96,570. There's a chance that you can even make a loss. So that is the problem when it comes to foreign transactions. Okay, so if it is 1,000 rupee, 2,000 rupee difference, obviously you won't mind, right? But in case you're dealing in the millions and the billions, the loss ends up being much higher. Okay, so what do we do? What do we do to prevent this thing happening? Okay, it's very simple. Today itself, after we get into the deal itself, there are certain measures that we can take. Okay, there are certain measures that we can take so that we know for sure how much we will be getting in 3 weeks' time. It is fixed. Okay, we might lose or we might gain from the transaction. That is different. But end of the day, there will be some clarity. There won't be any difference between the two values. Okay, because here, until 3 weeks later, you won't know for sure how much you're going to get. So we won't be in that position. We know from 3 weeks from today, we will get exactly 98,000 for sure. Okay, so that is what we try to learn here, right? So what are the different ways we can hedge this foreign exchange risk? We use the word hedging because hedging means we are trying to reduce the risk. Okay. So let me talk about the different ways we can hedge. Okay. Right. So the first thing that we can do is we can enter into something called a forward exchange contract. Okay. So forward exchange contract means we go to the bank. So let's say again, we are the exporter. No? So we are the exporter. We know that we will be getting $333 in 3 weeks' time. Okay. So today itself, we go to the bank and we say, look, in 3 weeks, I will have $333. I want to sell it to you. You have to give me Sri Lankan rupees. Okay. Today itself, let's fix the exchange rate for this $333. So the bank, they will have a particular forward exchange rate. They will say, okay, fine, $333. We will buy it at maybe 290, sorry, not dollars, 295 rupees per dollar. Okay, so you will bring 333, we will buy $1 at 295. So ultimately, you know, you will have exactly 98,235 rupees. That is not going to change. 98,235 you will have, because bank has promised, no, they have promised that we will buy your dollars at 295. So on that day, 3 weeks later, regardless of what the market foreign transaction rate is, whether it is 290, 298, 350, 370, doesn't matter. If the bank is saying we promise to buy at 295, they have to honor that contract and we will get the 98,235 to our hands. Okay, so that is the forward exchange contract. Then there is another type of contract called a money market hedge. Okay. Now, a money market hedge, to be honest with you, we are not going into, a direct kind of agreement with the bank, but we do a series of transactions. Okay, we do some deposits, we do some, withdrawals. So basically, we try to play with bank accounts. That's what we try to do. Okay, so with the help of a question, especially in this Zarona company, I will show you exactly how a money market hedge works. Okay, but basically for now, just remember that it is trying to play with the foreign bank accounts. Okay, trying to play with foreign bank accounts, and not everybody has access to it, but most of the time, if you're a large company, you will have access to foreign currency bank account. So normal individual can't do money market hedging, whereas a normal individual can do a forward. Okay, money market hedge, you have to have, a foreign bank account. You should be able to borrow in a foreign currency. So if you have those things in your hand and you don't have a problem with all of those things, then you can go ahead with the money market hedge. Okay, so what you have to remember with regard to a money market hedge, there are a few steps that you will have to remember. Okay, so let's say I'm trying to hedge a payment. Okay, a payment means I have to pay somebody in foreign currency. Let's say I have to pay somebody $300,000. I want to make sure that in the future day, when I pay 300,000, I know exactly how many rupees will leave my hand. Okay, so if I'm going to hedge a payment, these are the steps that I will have to follow. Okay, so you can just have a look at it. I know this is a completely different question. Just have a look at it, right? So if you are going to pay, remember, you have to pay somebody, right? So it is a liability. Okay. If you have a liability, meaning you have to pay somebody some amount, then today, now at a future date, you have a liability. So today, what do? You do the opposite, meaning you create an asset today. You create an asset today. Okay. So there are two things you can do. Either you can deposit money into a bank account or you can borrow money from a bank. Okay. Now, if you want to create an asset, obviously borrowing money from a bank is going to create another liability, right? So what do? You actually deposit money into a bank account. Okay. So first thing is you deposit $450,000. Okay. So just follow me. In 3 months' time, you will have to pay 450,000. So today you will deposit for a period of 3 months. The interest rate, just forget about it for now. You will deposit the present value of 450,000. Why will you deposit the present value? Because that liability of 450,000, you will have to pay in 3 months' time. So if I deposit just the present value today, then interest will start adding up in that particular bank account. And in 3 months' time, I will reach 450,000. Okay, that's the logic behind it. So what you have to know is, first is you will deposit for 3 months at whatever rate the bank is giving you. Okay, then Now, let's say, for example, you're a UK-based company. I'm telling you, go and deposit $444,444. Okay. Now, if I'm UK-based company, I only have pounds in hand. I don't have dollars. Right. So what will I do? I will go and buy these $444,444 from the bank. Now, always remember, as a rule, the bank buys high and the bank sells low. Okay. Why am I saying this? Because later on you will see in questions, the spot rate, usually they will give it to you like 1.7 to maybe 1.7500. So you should know which rate to use, right? So always remember, if you are a UK company, you want to deposit dollars, you will try to go and buy the dollars from the bank, meaning you have to, the bank is going to sell you those dollars. So if the bank is going to sell you dollars, that means they will always sell it to you at the lower rate. Okay, so that's why we have the 1.7. So you have converted 444,444 into pounds. Okay, so we have got the 261,438 pounds. Now, although I'm telling you, deposit this 261,438, you don't have this money in your hand, right? So what you have to do, you have to go and borrow 261,438 pounds at whatever rate they are charging. So in this case, they are charging you 7.5% into 3/12 is just because it's for 3 months. Okay, so then what happens? 261,438 into 1 plus 1.875%. So that is the interest component. So 266,340, right? So what happens? That will be the total amount that you will incur, meaning you will have to basically pay 266,340 for you to settle this $450,000 loan that you will have in 3 months' time. Okay. Now, now the reason why people find this difficult is because they feel that it's very difficult to explain this money market hedge. And I also agree, right? Because now this is how a liability works, and asset will work differently. Okay. So the only thing I want you to remember is this. It's a liability. Okay. So that means you have to create an asset. Creating an asset means you will have to deposit. Okay, so figure out what's the present value that you will deposit. And always remember, if it is in a foreign currency, you can't deal with that money. You have to somehow convert it to your home currency. Okay, so always convert it to home currency. Think whether the bank is going to sell the money to you or whether they are going to buy it from you, and decide on the rate. Then you have your pound figure and then decide, okay, 261,438 I have to deposit. Usually, if you start with a deposit, the second thing that you will do is the opposite, which is you will borrow. Okay, so if we started with a deposit, we will end with a borrowing. Okay, so that will just give you your total, 266,340. So what this means is, if you want to settle this 450,000 in 3 months, how much will it cost you? It will cost you exactly 266,340. We have decided that today itself. Okay, so this is how a money market hedge will work if it is a liability, a payment. Okay, if it is a payment, right? So what will happen if it is a receipt? Okay, so let's look at that. This is also a payment, right? So if it's a receipt, if you're receiving, in this case, we're receiving 900,000, it's an asset. Okay, so that means today you have to do the opposite. You will have to create a liability. Okay, you can either deposit or you can borrow. One of the two you can do. If you deposit, you're creating an asset. If you want to create a liability, you will have to borrow. Okay, so in 6 months, you're receiving 900,000. Borrow for 6 months. The rates will be given in the question. So today you will borrow the present value of 900,000, which is 871,671. Okay. Yes, 900,000 is a future value because you are receiving that 900,000 in 6 months' time. Okay, so that's why today when we are borrowing, we don't have to borrow 900,000. We will only borrow the present value of 900,000. Okay. Right. So that means you will end up borrowing 871,671. Now again, I'm telling you, you're a UK-based company. We are asking you to borrow in dollars. Okay, not everybody has the liberty to do that. So first of all, you have to have access to all of these dollar, bank loans and stuff. If not, you won't be able to do money market hedge. So what has happened now? We have borrowed $871,671. Now again, we are UK-based company. We don't want dollars. Okay. So what will we do? We will sell this to the bank. We will sell it. The bank will buy. Bank will always buy at the higher rate. So we want to convert this to pounds. So 871,671, when we convert it, it becomes 511,544. Now we have this 511,544 in hand. Okay. So what do? We go and deposit that money. Okay. In a pound bank account, we go and deposit that money. In 6 months' time, what will happen? This 511,544, you have to add whatever interest you're getting. You will end up receiving 526,890. So in 3 months' time or 6 months' time, okay, this is saying 3. In 6 months' time, this from this 900,000, you will receive 526,890. Actually, this 900,000 won't directly give you 526,890, right? Whatever you get, that $900,000, you will use it to settle this bank loan that you took of $900,000. Because initially we took a loan of 900,000, right? That we have borrowed for 6 months. That means that will also grow, and in 6 months it will be pending 900,000. They will ask you to pay. So with whatever you get 900,000, you will settle that off. But at the same time, in your pound account, you would have 526,890 to compensate for that $900,000. Is that clear? So this is how a money market hedge works. Okay. So again, the first step, identify whether you're borrowing or whether you're depositing. After that, this will always be a spot rate conversion. And here it will be the opposite of what you first did. So if you borrowed first, you will deposit next. Okay. So this is the money market hedge. Easily they can give you about 5 marks just to figure this out. So far, everything I have spoken about except for the rates. Okay. Rates, we have to have a look at the question to see the exact rate that we have to take. But otherwise, this is usually how the money market hedging works. Is it clear, or you want me to go through it again? A payment will end with borrowing. Wait a minute. Yeah, a payment is a liability, so it will start with creating an asset. Creating an asset is depositing. So correct, it will end with borrowing. A receipt means you're going to get an asset, so it will start with a liability. Liability means at the beginning you will borrow, so at the end you will deposit. Correct. Okay, so it's best if you can take these two down. Okay, so let me give you a minute. This is for, let me show you. This is for hedging a payment. Okay. You can just take this down if you want. Take a picture, screenshot, something. Okay, and this is how it will work, the calculation itself. Okay. So this is the payment that I have showed you so far. Receipt is this. Okay, so take a minute if you want, just to take a picture. And this is how the calculation will work. Okay. Right. So those are the only two calculations they can ask you in this paper, FM. Okay, so they can ask you for a forward or they can ask for a money market hedge. But in addition to this, they can ask you to explain something called a derivative. Okay, so what is a derivative? To be honest, it's like this. Now, say for example, in the example that I gave where we were exporting coconut, you saw that we were actually making a loss, right? I was supposed to get 100,000. I got some 96,000 odd. So I was making a loss, right? Now, suppose that particular transaction, I had not hedged it in any way, right? Now, suppose I want to hedge that transaction and I'm going to go and hedge it using a currency future. Okay, how will it work? It works this way, right? So I am making a loss from my transaction. Okay, so the transaction is a loss. Okay. Now, to compensate for this, let's say I lost by say 4,500 rupees. To compensate for this, if I had gone for a futures hedge, there will be a separate transaction that happens called a futures deal. Now, what will happen? The futures deal, basically, you will either buy or sell futures today and again buy or sell futures at the future date. Okay. Anyway, that's also like a transaction. So what happens if you're going to lose 4,500 from your original transaction, you will end up gaining 4,500 from the futures deal. That's how it works. Okay. So you don't have to know this in detail. Futures we cover in AFM. Okay. So for this paper, all you have to know is if the transaction results in a loss, the futures deal will compensate for that loss by giving a profit. Whereas if the transaction is giving you a profit, then the futures deal will compensate for that by giving a loss. So if one goes down, the other goes up. If one goes up, the other comes down. Okay, so ultimately what's happening, you're not making a profit or a loss. It's a nil situation. That's how a currency future works. But they can never ask you to do the calculations for FM. So what can they ask you with regard to futures, right? They can just ask you the characteristics of futures. Okay, so you can see they've spoken a lot about it. Currency futures are similar to forwards as they are binding, meaning if we buy the future or we sell the future, we have to finish off the deal. We can't stop halfway through. Fixed by the rate of exchange in the futures contract. However, it's different from a forward because it is traded on a futures exchange. Forwards are over the counter. So this is the thing. Futures, the difference between a future and a forward, I know I don't have a lot of time to speak about this. Basically, a forward, you go to the bank and you ask, okay, what's the forward rate? Okay. Now, after the bank fixes the rate for you, you can't go and sell that rate to somebody else. That is specifically only for you. Whereas a future, how it works is, if I buy a future at a particular price, I can actually sell the future to somebody else. So that's why we say it is traded on a futures exchange. It's like a share, where if I buy it at one price, I can sell it at another price to somebody else. Okay, so that is one thing about futures. Then there are settlements. They happen in 3 monthly cycles in March, June, September, December. Remember it in terms of your ACCA exams. March, June, September, December, you have exams. Same time, futures deals also close only in these 4 periods. Okay, and they're standardized in terms of contract sizes, meaning you have to hedge in blocks of 62,500. Meaning, if you're going to hedge, let's say 62,500 pounds, you can buy one future. But if you want to hedge, say 80,000 pounds, you can't buy 1.1 future, 1.2 futures. You have to buy one future or you have to buy 2 futures. So it happens in standardized sizes. Okay. So they speak how the futures contract works, right? So suppose there is an unfavorable currency movement negatively affecting the transaction, futures will generate a profit. If the currency movement gives you a profit, then the future will generate a loss. Okay. So if you choose to do FM, you will end up doing a lot of calculations to do with currency futures. So it's kind of lengthy. Actually, if we learn the calculation, it would make a lot of sense, right? Because I also find it like I feel some students don't get the hang of a future. The reason why that doesn't happen is because you don't learn how to do it. Okay, the moment you learn how to do it, everything will make a lot more sense. Okay, but anyway, it's fine for now. They can just ask you to write about it. That's it, right? Then we have a currency option. Okay, so currency option. There is a problem with regard to a forward exchange contract, a forward. Okay, and that is, let's say, now I'm an exporter again. The bank is saying you will get $333 now. I will buy it at $1 for, I will buy it at 295 rupees. Okay, that means I know I can fix and say that I will get 333 into 295. How much is that? I will get 98,235 from this deal. So that's great. Okay. But let's say on the date of transaction, when we got this $333, the actual exchange rate was 297 rupees. Just say. Okay. So 333 into 297, that is 98,901. Okay. Now you can see if you didn't have this forward, you could have actually got more money by just doing the transaction in the open market. But now because you have this forward deal, you have a problem. Like you will be getting less. You can't help it. You have to go ahead with the forward deal, right? So to counter this problem, we have another type of instrument called a currency option. So option means unlike the forward, if you want, you can take it. Meaning if you want, you can sell your $333 for 295 rupees. If you want, you can just let it be. You can just let the option lapse. We say we let it lapse, meaning we will just go and do the transaction in the market itself. So that way you can win, meaning you can make a profit if the currency movement is favorable. You don't make a loss if the currency movement is not favorable for you. Okay. So that is how a currency option works. But this thing doesn't come free of charge. Whether you exercise this option, exercise means you take the option, or whether you let the option lapse, one of the two, at the beginning itself, you will have to pay something called a premium. It's a premium. It's like an insurance, basically. Now, insurance is the same. No, if you want, if you go and knock your car, you can take the insurance. You can let it be if you don't want. But every year, you have to pay an insurance premium. Likewise, here also, an upfront premium you have to pay because you are the one who is going to benefit from this deal. Okay. So currency options also can be over the counter, meaning you can go to the bank and ask them for an option, or there are also traded options. Traded options means like a future, you can buy it from somebody and you can sell it to someone. Okay. So that's about the currency options. So that's what it's saying here. You have over-the-counter options as well as exchange-traded options. And there are two types. One is a put option and a call option. Put option means, just think of it like, like if you have a pack of cards, if you put it, it's like selling, meaning the right to sell. Okay. Whereas if you call, it's the right to buy. Okay. Right. So the most important thing, no calculations will be asked on derivatives in the exam. But if you choose to do AFM, you will learn how to deal with futures and options. Okay. So that's all you need to know with regard to foreign exchange risk. Okay. Futures and options, just know the theory. Forwards and money market hedges, you have to know how to do the calculations. Okay, so I hope everything is clear. I have gone through it as fast as I could. In case you have questions, please feel free to reach out. Okay, because usually this chapter tends to take time. But since we don't have that liberty, I had to go through it quickly. So let's try out this question. Okay. So let me give you a minute. You can read it first. The first is asking you, calculate the dollar cost of a forward market hedge. Okay. So let's see what it says. I'll give you about 5 minutes. Go through this question properly. When it comes to foreign exchange questions, I'm telling you this, always take time to read the question. Okay, that's a very important thing. A lot of people try to run through it quickly and you tend to make mistakes. Take time to go through it. It won't, it will never be a disadvantage for you. Okay. So always, what's the home currency? Okay, because you have to understand in your exam, they won't give you currencies that you know. Because sometimes now, for example, we know that the dollar will be stronger than the pound will be stronger than the dollar, or dollar is stronger than the rupee. So we know that. So, we'll be able to do the question based on our knowledge, right? But in your exam, they will give you some, la la land or some country that doesn't exist and say, this is only their currency. So you won't be able to guess whether this currency is stronger or not. So first thing is you have to properly identify what you know. So they're saying their home currency is the dollar and they took out a fixed interest peso bank loan several years ago. Now for some reason, they have taken a peso loan, although peso is not their home currency. We don't know why they did that. So they're saying because peso interest rates were relatively cheap at that time compared to the dollar interest rate. So clearly, because the interest rate was cheaper for the peso, they decided to take a peso loan. Zarona company does not have any income in pesos. Okay. Economic difficulties have now increased peso interest rates while dollar interest rates have remained relatively stable. Now the peso interest rate has increased, whereas the dollar interest rate is almost the same. Now, Zarona company must pay interest on the dates set by the bank. Now, they have taken a peso loan, so obviously they have to pay interest in peso. So, bank only decides on the payment. A payment of 5 million pesos is due in 6 months' time. Okay, so in 6 months, we have 5 million pesos that we have to pay. Okay, so this is a payment. Okay, so in 6 months, we have a payment of 5 million pesos. The following information is available. So you have the spot rate, a 6-month forward rate, interest rates which can be used by Zarona. So the moment you see these interest rates, chances are they will ask you to do a money market hedge. Okay. Then they're saying calculate the dollar cost of the forward market hedge to the nearest dollar. Okay. So it's a payment of 5 million pesos in 6 months' time. So the question is, in dollars, how much will you end up paying if you go for a forward market hedge? Okay, so let me just to help you out. This is the question. So I'll give you a minute. See if you can figure it out. If you go for a forward market hedge. You have an answer. Right. So first thing you have to identify is if you have a forward rate like this, right? 12.805, 12.89889, you have to identify which rate to use. Okay, so to decide which rate to use, you have to decide whether the bank is selling or whether the bank is buying. Okay, so we're talking about a payment of 5 million pesos, right? So again, we are a US company. We don't have pesos. We have to buy pesos from the bank. We have to buy pesos from the bank, meaning the bank sells pesos. Always remember the bank sells low. Okay, so between these two rates, 12.805 and 12.889, they will go for the lower rate, which is 12.805. Okay, so payment of 5 million pesos. If you want to convert 5 million pesos to dollars, some people have a problem. They don't know whether to multiply or whether they have to divide. Okay, so get this also clear, right? You can see here, $1 is buying you 12 pesos. Meaning with $1, you can buy a lot more pesos than the dollar. That means the dollar is only strong. The dollar is strong. Okay, so now 5 million pesos, if you want to convert it to dollars, think of it like this, right? Now, Sri Lankan rupees is always weak. Most of the time, it's weak. So, if you want to convert it to a stronger currency, in terms of the number, now this is 5 million now. So, in terms of the number, when we convert Sri Lankan rupees to dollars, usually the dollar figure in terms of number will be smaller. Get it? Our 1 lakh rupees is equal to $333. 333 is smaller than 1 lakh. So here also 5 million, since it's in the weaker currency, when you convert it, the number will become smaller. So if you want any number to become smaller, you can't multiply, you will have to divide. Okay, so that will be 5 million divided by 12.805. $12.805. That will be $390,472.5. But again, careful. They're asking you to round it to the nearest dollar. Okay, so you will have to do that. 390,472. If you don't round it, now again, now this is an example of an MTQ, right? So you don't have the spreadsheet with you. So if you don't round it, it will mark it wrong. Okay, so make sure you pay attention to whatever they are saying in brackets. That's very important. Okay. So there will be 390,472. You shouldn't put commas. Okay, you should just put the answer as it is. Right. Then it's saying indicate by clicking on the relevant box whether each of the following statements relate to interest rate parity only, to purchasing power parity only, or to both. Okay, so you should be familiar with the purchasing power parity theory and the interest rate parity theory. What do you think the answer should be? Okay, so let me read it. It's saying the currency of the country with a higher inflation rate will weaken against the other currency. Okay, so if you're talking about inflation, clearly it's not interest rate parity, because in interest rate, we only speak about the interest rate. We don't talk about inflation. So that is purchasing power parity. Okay, so that will be the second box. You will have to click that. Okay, so first is not IRPT, that will be purchasing power parity, I asked it, because we are talking about an inflation rate, not an interest rate. Okay. Second is saying the theory holds in the long term rather than the short term. Both will hold in the long term. Okay, both interest rate parity as well as purchasing power parity, they hold in the long term, not really in the short term. Okay, so that will be both. The exchange rate reflects the different cost of living in the two countries. Actually, the different cost of living in two countries means talking about two different countries, right? So what we're trying to say is, if you're going to buy something in, say, the US, and you're going to buy the same thing in the UK, okay? Overall, if you negate, the cost of living and, so many other, factors that is relevant only to the US and the UK, ultimately, each good or service, it should cost the same in every country. Okay, the difference in cost is because of the difference in cost of living. So we also see that, right? Sometimes you see in the US, people are paying so much for something like a internet bill, whereas we pay just about 2,000, 3,000 maybe a month, and we are done. We get 100 GB, 200 GB. It's unheard of for them. Unlimited YouTube is unheard of for them. Why? Because the cost of living in the US is much higher than over here. So what happens is, if you're going to buy the same product, according to the purchasing power parity theory, if you are going to buy the same product in both countries, it should be the same. The only reason why there is a difference is because of the difference in cost of living. Okay, so that will be purchasing power parity only. Okay. Right. Now, this is a money market hedge. They're not asking you to they're not asking you to do the money market hedge, but without knowing, the order for a money market hedge, you won't be able to do this question. Okay. So I will help you out, but before that, I just want to see if you can figure it out yourself. Okay. So let me just copy this and give you the question. They're asking you for the proper borrowing rate and deposit rate in a money market hedge. You're supposed to match. Now, like borrowing rate, what it should be, match it. Deposit rate, what you think it should be, you have to match. I'll go to the question. What do you think should be the answer? So borrow, you're saying at 10% and deposit at 3.5%. Okay. Let's see. Okay. So what's the situation? We are talking about a payment, right? So go in order. A payment of 5 million pesos. Okay, so a payment is a liability, right? So that means you will have to create an asset. So let's do that. Okay. So when are we going to pay this 5 million pesos? They're saying it's due in 6 months' time. Okay. So in 6 months, you will be paying 5 million pesos. That's the situation. So what will you do? You will create an asset today. Okay. So let me do that. Let's create the asset over here. Create an asset. Okay. So an asset means obviously you can't borrow, right? So if you're talking about an asset, you have to deposit pesos. So if you look at the peso interest rate, the deposit rate is 7.5% per year. Okay, but we are not going to deposit for one entire year because we need it only for 6 months. So we're talking about 7.5% into 6 over 12. Okay, so we're talking about depositing it at 3.75%. Okay, so that will be the deposit rate, 3.75%. Okay, so let me just continue. They're not asking for the entire calculation, so we don't have to go through everything. They just show you, right? Okay, I can't draw a line, so it's fine. Okay, so then what happens today? Today, what will happen? I will deposit the present value of 5 million pesos, whatever that may be. Okay. Then what will happen? If you have to deposit the present value of 5 million pesos, because I am not a company where my base currency is this peso, I will have to convert it to my base currency, which is the dollars, using the spot rate at that time. Okay. So this will give me some answer that I will have to convert it using the spot rate, and that will give me another answer, but this will be in dollars. Okay. Then what will I do? Since I deposited first, now I don't have money to go and deposit, right? Although I'm telling to deposit this many dollars, I don't have it. So I will borrow that many dollars, right? So when you look at the dollar interest rate, it is 4.5 per year. Okay. So I will borrow at 4.5% per year. I don't need it for an entire year. I just need for 6 months. Okay. So 4.5 into 6 over 12 is 2.25%. So once I borrow that particular amount, it will come over here in 6 months. So that means in 6 months, how much I will actually incur in dollars to settle this 5 million pesos, I will get when I get this answer. Okay. So ultimately, they're not asking for anything much here. They're just asking you for the two rates. Deposit rate is 3.75. Borrowing rate will be 2.25. So first, okay, so now here when you're taking 5 assets, you have taken 10%. But that is the borrowing rate. If it is a liability, first you will create an asset. So if you create an asset, you will deposit pesos. So that means you have to take 7.5%. Okay. And if you deposit first, you will borrow later. But borrowing, you won't borrow in pesos, right? Because we have already done the deposit part. We have dollars in hand. So we have to borrow in dollars. So the dollar rate will be 4.5 into 6 over 12. Is that clear? Right? So this is how the money market hedge will work. Right. Which two of the following are possible ways for Zerona company to hedge its current foreign currency risk? How can they hedge their foreign currency risk? Two ways. Okay, so actually I did not show you that slide. I'll just go through it since the question is asking. So there are other than this money market hedge, other than the forward, there are other ways in which you can deal with this foreign exchange problem. Okay, so there are certain few things, right? Not much. One is you can deal with your home currency. That means don't ever quote anything in a foreign currency. Always quote in your home currency. So if you are exporting coconuts to China, don't give them the price in dollars. Give it in rupees itself. So let them deal with any foreign currency problems. Second thing is you can do nothing. Doing nothing means, why we are saying do nothing? Because we believe that one transaction, if you lose, another transaction you will gain. Okay, so more or less we are saying one you will lose, one you will gain. Overall, it will be a like a flat situation. So don't worry too much about it. Okay. Second thing, if you are happy with that, you can do that. Third is leading. Leading means you go and make payments quickly. Okay, so go and make payments quickly, or you encourage your customer to pay you quickly. So lead, try to do everything quickly, because the faster you go through with the payment, the less you will have to deal with any foreign exchange fluctuation. Leading. Other one is you can lag. Lag means you delay it. Now, if you feel that the exchange rate in maybe 10 days time, it will move favorably, meaning you will be able to make a profit in 10 days time. What do? You delay your payments. Okay, so that is that. Or you can match your receipts and payments. What that means is, just look at this picture. You have a US customer. ABC is based in the UK. You have a US customer. You're supposed to get $16 million from him. And you're supposed to pay a supplier $10 million. Okay, so what you do is you kind of net it off. Okay, so from the 16 that you get from the customer, you immediately pay 10 million to the supplier. So the only amount that you have to hedge is the remaining 6 million. So you don't have to hedge the entire 16 million and the entire 10 million. You net it off and only hedge the remainder. Same thing over here, netting it off. Netting it off means, but in this case, we were netting off a customer and a supplier. Here, what we do is, let's say there are about 3-4 payments that has to go in dollars to different companies. So what you do is, you first of all, net off everything and make sure that there is only one payment. Okay, so 3 companies or 1 company, you have 3 payments to make. So make sure you always net everything and try to bring it to 1 or 2 transactions. Okay. Next is you can have a foreign currency bank account. Okay, so that means you don't have problems at all. You will keep money in dollars itself. You will never have to convert it. Finally, you can match your assets and liabilities. That means if you have to pay a liability, meaning now in this case, this Zerona, they had to pay an interest in pesos. So what they can do is they can set up an asset that will give them income in pesos. So you get income in pesos and you have an expense also in pesos, matching. Okay, so these are certain techniques you can use. If none of them work, then you can go for the forward or the money market hedge, because this happens within the organization. A forward or a money market is you have to start going to external parties, right? So based on that, can Zerona match their receipts and payments? What do you think with regard to that peso interest payment? If you look at the question, they say they don't have any peso income. Okay, so even if they want to do a matching, they can't because they don't have an income, right? Can they do a currency swap? Okay, we don't really go into swaps. So let's just keep that. We'll just try to eliminate at this point. Can we lead or lag? Meaning, can we pay early or can we pay late? Definitely you can't, because this is to do with an interest payment to the bank. So if the bank says pay on this date, you have to pay on that date. You can't say I will pay early or I will pay late. So definitely C is out. So even if you don't know what is a currency swap, you know the answer will be currency swap and currency future. Okay. So what is this currency swap? It's like this. Sometimes you can, like, we don't go into detail again. We don't go into detail with regard to swap, but we can swap with somebody else with regard to that peso payment. Okay, so if somebody else had to pay in dollars, okay, let's say somebody else had to pay a bank an interest payment in dollars, we have to pay in pesos. Okay, now we may be comfortable paying in our home currency, which is dollars. They may be comfortable paying in pesos. So what do? We swap the interests. We go and pay their interest in dollars. They pay our interest in pesos. Okay, that's how the currency swap works. Again, they won't ask for any calculations whatsoever. Okay, but swap means two parties, they swap their liabilities or assets, whatever it is, we swap it with each other. Okay. Right. Question 25, they're talking about again, I think, a money market hedge, but it's a completely different scenario. So they're not talking about this in the question. It's a completely different scenario. What do you think the answer should be? They're giving basically the steps of a money market hedge. But in this case, it is a receipt. Earlier it was a payment. Now it's a receipt. Is it A, B, C, or D? I know it's tricky. Definitely tricky. What do you think? A, B, C, or D? Okay, okay. No issues, Astin. Okay, so let me try it out because there will be others also watching online later. Right. So Zerona company also trades with companies in Europe, okay, which use the euro as their home currency. So in 3 months' time, we will receive how many euros? 300,000 euros. Okay. So they're asking you, which of the following is the correct procedure for hedging this receipt using a money market hedge? Okay. So if it is a receipt when in 3 months' time. Okay. So first of all, put 3 months over here. Okay. So we have 300,000 euros, which is a receipt. Okay. So receipt means we are talking about an asset. So that means today what you have to do, you will have to create a liability. So creating a liability means you can't deposit, obviously, you will have to borrow. Okay. So borrow, now they are not asking about percentages. They just want to know, should we borrow in euros or dollars, right? So here at this point, we are going to borrow in euros. Okay. So today what happens? We will borrow the present value of 300,000 euros. That's what we will do. That's what we're going to do today. Okay. Then what will we do? We will convert this because we are in our base currency is dollars now. So we will convert this to dollars using the spot rate. Using spot rate. Okay. Then we will have that $300,000 as a dollar figure over here. Then what will we do? Since we borrowed earlier, now we will deposit the dollars at whatever interest rate. Okay. And then we took a loan. No? So we created a liability. We actually borrowed 300,000 euros. Okay. Now in the dollar account, there will be some number of dollars. But what is going to happen? In 3 months' time, your customer will pay you 300,000 euros. You use that 300,000 euros to settle this initial loan that you took. Okay. So over here in your dollar account, whatever you have, that's for you. And whatever the customer pays, 300,000 euros. So whatever he pays, you will set off the euro loan with. So the 300,000 that the customer pays you, you will use that to set off your euro loan. Okay. So what are we doing? We are borrowing an appropriate amount in euros. That is correct. Then we are converting it into dollars. That also seems to be correct. Then we are placing the dollars into deposit. Yes, that is step number 3. And then finally, we are using the customer payment to repay the loan. Exactly the order that we have over here. Okay, so actually A is correct. Okay, the others are in different orders, so you don't have to go through it. You will get confused. Just, the moment this kind of question, the moment you see the correct answer, the best option is to select it. Okay, so then it will be A. Right. So that is it for this particular MTQ. So this is the second MTQ in this paper, right? So let's take a quick break. Okay, and come back. It's 7:20 now, right? So let's come back at 7:40 and we will finish off this paper today. Okay. Okay, so we're just waiting in case Ashtad was going to join. It's fine. Okay, so let's start the next question. So it says here, Redact company operates in an industry which has recently been deregulated as the government seeks to increase competition in the industry. Okay. So what that means is deregulation means earlier the government had put some sort of restriction. Okay, there was some sort of regulation, some sort of restriction, which now they have eased. Okay, so they're saying it has been deregulated means now it is, they can basically run their business more freely. So the reason the government has done that is to increase competition. So it's very clear. Now, once it gets deregulated, more and more entrants will be interested in coming into this particular industry because there is no regulation. So what happens? Obviously, competition for Redact will increase. So it's saying Redact company plans to replace an existing machine and must choose between two machines, either machine 1 or machine 2. Okay. So they're talking about each of the two machines. Machine 1 has an initial cost of 200,000 and will have a scrap value of 25,000 after 4 years. Machine 2 has an initial cost of 225,000 and will have a scrap value of 50,000 after 3 years. And we have the annual maintenance cost of the two machines. So machine 1's maintenance and machine 2's maintenance. Where relevant, all information relating to this project has already been adjusted to include any expected future inflation. Taxation and tax allowable depreciation must be ignored in relation to machine 1 and machine 2. Redact has a nominal before tax weighted average cost of capital of 12% and a nominal after tax weighted average cost of 7%. So everything that we need for calculations seem to be there. Question 26 is saying, in relation to Redact company, which two of the following statements about competition and deregulation are true? Okay. So this is about the fact that they deregulated because they wanted more competition, right? So the first point is saying, increased competition should encourage Redact company to reduce cost. So if you have more competition, there are a lot of people competing in the market, okay? So if you want to maintain your market share, if you want to maintain your customer base, basically, you have to give them a competitive price. Okay. So if you have to give them a competitive price, then obviously you have to figure out a way to reduce your cost because only then you can give them a cheaper price without eating into your profit margins. So the first point, it seems to be correct. When you have more competition, you will consciously take an effort to reduce your cost because only then you can maintain low selling prices as well as your profit margins. Okay, so one is correct. Second is saying deregulation will lead to an increase in administrative and compliance costs for Redact company. If there's deregulation, that means we don't have anything to follow. There is no compliance or, there's nothing much to follow. They're telling you freely do business, do whatever you want. We're not going to come and put our heads into it. Okay. So if there is deregulation, then there will actually be a decrease in admin and compliance cost. There won't be an increase. Okay. Deregulation should mean an increase in economies of scale for Redact company. Economies of scale means they are going to basically produce in large quantities, right? Deregulation doesn't necessarily mean that directly. Okay, because for example, if there is more competition, then maybe our sales might drop. In that case, we won't have economies of scale. Deregulation could lead to a decrease in the quality of Redact company's products. That may be true. Because when there is a regulation, for example, there are so many regulations, right? For example, if you want to sell mobile phones, there are certain regulations, like in Sri Lanka, it has to be approved by the TRCSM. Okay. So if there is regulation, then you will make sure that the quality is top notch, because if the quality comes down, you will have to face the consequences. But if there is no regulation, there's deregulation, then there's nobody to come and look into your quality and what you're actually producing. Right? So there is a chance that the moment you deregulate, you will actually decrease the quality of the product. It is possible. Okay. So D also will be an answer. Right? So that is for 26. 27 is asking, what is the equivalent annual cost of machine 1? Okay. So let me crop this to remove 26. Right. So equivalent annual cost is actually a part of investment appraisal. there was an equation for it. It is the NPV divided by the annuity factor. It's the NPV divided by the annuity factor. So if they are asking for EAC, then first of all, based on this information, you have to be able to calculate the NPV. Once you get that, it's just about dividing with the annuity factor. Okay, so let me just give you guys about 2 to 3 minutes, okay, to see if you can figure out how to calculate NPV. In this case, it's not a normal NPV calculation also. Okay, because when it comes to EAC, the type of NPV calculation that we calculate, it is slightly different. Okay, but I mean, in terms of the structure, everything is the same. But in terms of the data that we put in, it is slightly different. We don't put cash flows, for example. In this case, we will look at something called the maintenance cost. Okay, so have a go. See if you can do the NPVs. And if you have and you're confident with the NPV, then it's just a matter of dividing it with the annuity factor. Okay, so again, be careful here. We're talking about machine 1. So don't make the mistake of taking machine 2's information to calculate EAC. Okay, so let me also work on it. You can work on it at the same time. And then we'll see if we can both arrive at the same answer. Okay. So as always, NPV, it goes this way. We put the years first. So let me put years over here. 0, 1, 2, 3, and 4. Okay. So with regard to machine 1, right, we know that there is an initial cost of 200,000 and a scrap value of 25,000 after 4 years. So let's put that in first. Okay. So we have an initial cost of how much? 200,000. So we put that negative. And you will have a scrap value of 25,000 after 4 years. Okay. Right. What else do we know about machine 1? We know that there are annual maintenance costs for machine 1 from year 1 to year 4. So we will have to put the maintenance cost as well. Okay. So in year 1, they're saying it will be 25,000. It's a cost, obviously. So it will be negative. 29,000 negative. Then 32,000 negative. And 35,000 negative. Okay, so that's it in terms of cash flow. So why I said it's a little different to a normal NPV, guys, is because we are not including any cash inflows. We don't have the sales. We don't have the cost of sales. None of them is there. The only thing we have is the maintenance cost and the initial cost and scrap value. Okay, so when it comes to the EAC calculation, remember the NPV that you calculate is slightly different. Most of the time, it's only these 3 figures that you will have to include. Okay. So now it's a matter of getting totals. Okay. So we'll call this the net cash flow. Okay. So here it will be minus 200,000. Here it will be the same, right? Minus 25,000, minus 29,000, and minus 30,000. And here it will be 25,000 minus 35,000. So that will be minus 10,000. Okay. So next is you need to take the discount factor at the appropriate percentage. Okay. So it says here, it has a nominal before tax weighted average cost of capital of 12% and a nominal after tax weighted average cost of capital of 7%. Okay. So if you have got the cash flow so far. Now you must be wondering, okay, do I take 12% or do I take 7%? Okay. So right now it'd be a good idea to go back, check your notes, see if at EAC we take the before tax weighted average or the after tax weighted average cost of capital. Okay. Actually, this part is a little tricky. Okay, so let me take you to my slides a bit, to the slide where we learn about EAC. You also might have learned it at some point. Not yet. So under equivalent annual cost here. So let me see. Right. So if you look here, it says, in most questions, tax and inflation are ignored. Okay, so when we do EAC, we make a lot of assumptions. Okay, so of them, there are 5 that you have to know. It's there on this slide. You can pause it and read through it. But the one that I'm interested in right now is the fact that tax and inflation are ignored. Okay, so if you're going to ignore tax and inflation, guys, be careful. Okay, before tax weighted average means we are including the impact of tax. I'm sorry, before tax means we are not including the impact of tax, whereas after tax means we are including the impact of tax. Here we make an assumption that we have to ignore tax. So you will have to use the before tax weighted average cost of capital, which is 12%. Okay, so careful there. Right, so always the discount factor at year naught will be 1. At 12%, go to the present value tables and get the discount factors, which will be 0.893, 0.797, 0.712, and 0.636. Okay, you can take totals here. Present values, right? So 200,000 into 1, get it for all the years. Okay, so then you can get a net present value. Okay, so that will be the total of all of these present values, which is negative 274,582. Okay, so don't worry about the fact that NPV is negative, right? It's negative because we have only taken the cash outflows, maintenance only, right? We have to consider sales and everything. When we do the consideration of sales and stuff, we will probably get a positive NPV. That's why we are going ahead with the project. Okay, so always remember when you're doing the EAC calculation, NPV most probably will be negative, right? So we have the NPV 200, and you can ignore the negative sign, 274,582. You have to divide it by the annuity factor at 12% for 4 years. Okay, so annuity factor at 12% for 4 years. Let me put it down again. 274,582 divided by 4 years, annuity factor 12% is 3.037. Okay. So that will be 90,412. Okay. So let's see if that answer is there. Stand right at the beginning. Okay. So A, 90,412. That is the equivalent annual cost of machine 1. Okay. Right. Question 28 is saying, in each of the following statements about Redag Company's use of EAC method, which of the following is true and false? Okay, so the first is saying, Redag Company cannot use the equivalent annual cost method to compare machine 1 and 2 as they have different useful lives. That's wrong. Okay, we use EAC itself when there are 2 different options with different useful lives, right? Because we are taking into account all the cash flows of all the years and dividing it by annuity factor. for the number of years we have in the question. So whatever difference you have with regard to the number of years, that is going to get sorted out by that division with the annuity factor. Okay, so the first one is false. The machine which has the lowest present value of costs should be selected by redact company. See, lowest present value, that's wrong. Okay, the lowest NPV is not what we select, right? So how we go about in this situation is, we have calculated EAC for machine 1, right? So the next step would be to calculate the EAC for machine 2. And whichever machine has the lowest EAC, we will choose. So in this case, they're saying to choose the machine with the lowest present value. That's wrong. We don't compare the NPV. We compare the two EACs, equivalent annual cost. So whichever has the lowest equivalent annual cost, that will be selected. So this is also wrong. 29 is saying, doubt has been cast over the accuracy of the year 2 and year 3 maintenance costs for machine 2. On further investigation, it was found that the following potential cash flows are now predicted. Okay. So they're saying year 2 and year 3 maintenance for machine 2. What was that they said? They said it's supposed to be 20,000 and 25,000, right? Year 2 and year 3. But they're saying we are not sure. It might not be that. And they're saying after that, for year 2, it can be 18,000 and the probability of that is 0.3. And for year 2, it can be 25,000 and the probability of that is 0.7. Okay. And year 3, initially we predicted how much? 25,000. But they're saying it can be 23,000 and the probability is 0.2. It can be 24 and the probability is 0.5. Or it can even be 30 and the probability is 0.45. Okay. So they're saying calculate the expected present value of the maintenance costs for year 3 to the nearest dollar. So just year 3's figures. Okay. So expected present value of the maintenance cost, right? So this is how you would do it. First, get the expected value. After that, we can make it a present value. Okay, so expected value. Always follow your words. These are the 3 things that can happen, right? So we have a cash flow of 23,000 and the probability of that happening is 0.2. Or we have 24,000 and the probability of that is 0.35. Or the third option is you will have a cash flow of 30,000 and the probability of that happening is 0.45. Okay, so take the total of this. Expected values total will be 26,500. Now, if you want to make this expected present value, then this is a year 3 based future value, right? So you have to multiply this with the discount factor at 12% for 3 years. Okay. So discount factor at 12% for 3 years, that will be 26,500 into the factor is 0.712. That should give you the expected present value as 18,868. Okay, that should be the expected present value to the nearest dollar. Okay. So with regard to expected values, I always say this in classes, remember to follow your words. Okay, so if you use the word and, like you can see, I'm saying 23,000 and the probability is 0.2. So whenever you use the word and, multiply. And whenever you use the word or, add. So in this case, 23,000 and the probability is 0.2. Or it can be 24,000 and the probability is 0.5. Or the cash flow can be 30,000 and the probability of that happening is 0.45. Okay, so as a rule, always remember and means multiplication or means addition. Okay. Right. Redact company is appraising a different project with a positive NPV. It is concerned about the risk and uncertainty associated with the other project. Which are the following statements about risk, uncertainty, and the project is true? Okay. So we're just supposed to select one that is true, right? So first is saying sensitivity analysis takes into account the interrelationship between project variables. That's very wrong. Okay, because in sensitivity analysis, we assume that, okay, one variable is changing, all the other variables are going to be constant. We don't take into account a situation where more than one variable will change. That's wrong. Probability analysis can be used to assess the uncertainty associated with the project. No. Probability means we can associate only the risk because we can give the quantified figure. But uncertainty, it's very difficult for us to give a number to it. C is saying uncertainty can be used to increase, uncertainty can be said to increase with project life while risk increases with the variability of return. That is actually correct. Okay, uncertainty means it will increase with project life because the longer the project life, the more different scenarios that can come into play. Right? For example, in 2 years, let's say 100 different things can happen. Obviously, in 20 years, 1,000 different things can happen because the period is longer. So uncertainty increases, whereas risk, the definition itself is variability of return. So that is exactly what the third point is saying, which is correct. A discount rate of 5% could be used to lessen the effect of later cash flows on the decision. Okay, so regardless of what the discount rate is, okay, the decision is based on present value. Okay, so we have completely removed the effect of the time value of money. After that only we are taking a decision when it comes to NPV. So regardless of what the discount rate you use, nothing is going to impact the final decision. Final decision is based on present values, which is already brought back to the current year's terms. Okay, so D also doesn't seem to make sense. So the answer there will be C. Right. So that's it for section B. That is it for the MTQs. Okay. So we start with section C, which is the scenario-based questions. So these are the questions where you will be given a spreadsheet for you to properly sort out your answers. Okay, so since it's 8:10 now, I guess we won't have time to finish both. But let's, aim towards finishing one. We have another TRG. We can finish that up, the next one as well next week, and do something extra. Okay. Right. So it says here, so this is what you will see in your exam, right? It says this section of the exam contains 2 constructed response questions. Each question contains a scenario which relates to one or more requirements, which may be split over multiple question screens. Each question is worth 20 marks and it's compulsory, and the entire section is worth 40 marks. Okay. And the important thing here is you have to put all your workings in the spreadsheet or the word processor. You have something called a scratch pad, but the scratch pad examiner can't see. Okay, so the only thing that he can see is your spreadsheet and your word processor. So make sure you put everything in that. Okay, in my opinion, it's best to not even use the scratch pad. Okay, because sometimes there is a situation where you might do some calculation and keep it in the scratch pad. You will forget about it. You might not include it in your answer, which will make you lose marks. Okay. Right. So it's a good idea to always, go through the requirements first, right? So it's saying calculate the following values for the investment appraisal: a net present value, an IRR, a return on capital employed based on average investment. So ROCE. Okay, so NPV, IRR, ROCE. Then they're saying discuss your findings in each section of A previously and advise whether the investment proposal is financially acceptable. Okay, so we have to look at NPV, IRR, ROCE and see if it is acceptable. And then the C part is saying discuss how the objectives of VIP stakeholders may be in conflict if the project is undertaken. Okay, so there are 2 areas worth 9 marks. Okay, so B and C both together worth 9 marks, which is entirely based on writing theory. Okay, and then based on calculations, you will get the remaining 11 marks. Okay, right. So let's read through the situation. We have to calculate the NPV. It's a big question, so let's, right. Okay, so this should give you good practice for NPV. Can give you guys a minute to go through it. Right. So let me read through the question. It's saying here, VIP company is a large stock exchange listed company, is evaluating an investment proposal to manufacture product W33. Okay, so we have a particular product which has performed well in test marketing trials conducted recently by the company's research and development division. Product W33 will be manufactured using a fully automated process, which would significantly increase noise levels from VIP's factory. Okay, this has nothing really to do with NPV. Okay, so most probably the other part of the question, that is B part or C part, they might relate to this information. So we'll just read through it. We'll come back to it when we come to that part. The following information relating to this investment proposal has now been prepared. Okay, so we have the initial investment, the selling price in current terms, expected selling price inflation, variable operating costs in current terms, fixed operating cost in current terms, expected operating cost inflation, which is 4% per year. So we have a lot of inflation happening over here. The research and development division has prepared the following demand forecast as a result of its test marketing trials. The forecast reflects expected technological change and its effect on the anticipated life cycle of product W33. So they're giving us the demand as well. Okay. It is expected that all units of product W33 produced will be sold in line with the company's policy of keeping no inventory of finished goods. No terminal value or machinery scrap value is expected at the end of 4 years when the production of W33 is planned to end. For investment appraisal purposes, VIP uses a nominal or a money discount rate of 10% per year and a target return on capital employed of 30% per year. They're asking you to completely ignore taxation. Right. So because they are giving me the money discount rate, which is including inflation, I don't have a choice. Before I do NPV, I will have to inflate all my figures. Okay. So let me start with the income. Okay. So let me start with the income. Okay. Right. So VIP company income. So let me put the years 1, 2, 3, 4. Right. So according to the question, I have a selling price of 20 per unit in current terms. Okay, so that means I have to inflate it for years 1 to 4, right? So let me put the selling price, right? So for year 1, it won't be 20, it will be 20 multiplied by 1.04. Because it's a, sorry, 1.03, because it's a 3% inflation every year. So 20 into 1.03, this will be 20.6. Okay. Here it will be 20 into 1.03 to the power 2. That will be 21.22. So here it will be 20 into 1.03 to the power 3. And here, you don't have to do it like this. I'll show you an easy way to do it also. I'm doing this so you can see the formulas, okay? 0.3 to the power 4, I believe. Yeah. Okay, so let me make this all to 2 decimal places. Okay. Now, you don't have to put in formulas all the time, right? You can do it this way also. In your exam, do it because it will make things faster, right? So this is 20 into 1.03 now. Okay, so here what you do is put it as 20, no, sorry, put 20.06 into 1.03. Okay, so that way now I have formulated it to take the previous sales figure and multiply that by 1.03. So then if I drag this, it will do the same thing for years 3 and 4. So what has happened here, it has taken the previous sales figure, multiplied it by 1.03. Here also it has done the same. Okay, so it's a faster way to use the formulas. But if you're not comfortable, then fine. You can do it the first way also. Okay, so we have the selling prices. So let's find the sales revenue. We had demand every year. Let me just copy it. It was 60,000 in year 1, 70,000 here, 120,000 here, and 45,000 here. Okay, so if I want to get the sales revenue, I basically have to multiply 20.6 with 60,000. Let me put some numbers here. No need decimals. Okay, so that's the sales revenue. We have inflated it and then multiplied it with the demand figure. Right? Now let's look at the variable operating costs. Okay, so let me just do the second one. So working again, operating cost. Okay. Right. So again, you will have your years 1, 2, 3, 4. Okay. Then you have to inflate your variable cost now, right? So inflated variable cost. Here also you can say inflated selling price. Okay. So what will it be in year 1? It is initially 8. You have to inflate it by 4%. So 1.04. Here it will be 8. 1.04 to the power 2. Here it's going to be 8 into 1.04 to the power 3. Over 4. Okay, so I have inflated it. Let me bring it back to one decimal place. Okay, so 8.32, 8.65, 8.9, and 9.36. Okay, so if I want to know the total variable cost, again, I have to multiply it with the demand figure. So let me take the demand here. So I can take total variable cost 8.32 into 60,000. Let's do that for all the years. Total variable cost is also there. Let's just clean it up a bit. In your exam, sometimes you might not be able to, usually we tend to formulate the entire Excel sheet, right, to have the commas and the decimal places. But sometimes in your exams, it won't be formulated. Okay, so that's why I have kept my Excel this way itself. So you guys also get used to the fact that you might have to, round it up properly in your exam. Then we have the inflated fixed cost, because fixed cost is also inflating. So let's inflate fixed cost. Okay. So that will be 170,000 is in current terms. So 170,000 into, I will have to inflate it by 1.04. Okay, so here also let me inflate it by 1.0. You can do that every year. Okay, so, oops, right? 176,800, 183,872, 191,227, and 198,876. So that is the variable cost plus the fixed cost. So I can take a total cost figure, okay, which will be simply this figure plus this figure, right? So let's do that every year. Okay, so I have the sales revenue, I have the total cost. They're telling me to ignore taxation. I seem to have taken everything else into account. So let's go ahead and start the NPV calculation. So NPV. Okay. So let's start with the sales revenue. I'll just copy it here. Since it's formulated, okay. Yeah. Then let's copy the total cost. So when you formulate it, you obviously have this problem, right? So make sure that you paste only the text. These are the years, right? So let's just, right? So we have the sales revenue and the total cost, right? So what I can do is I can get a net cash flow. So how do I do that? It's basically your sales revenue minus the total cost. So net cash flow will be this minus this. Do that every year. Okay. Right. So you have the net cash flow as well. I think I missed something. Yeah, I missed one small thing. That is, they spoke about an initial investment being 2 million. Okay, they said the initial investment was 2 million. So let me add that in here. Okay. Okay. So let's insert a column here to make it easier for me. So let's do this. Because we need year not now. This is the advantage of having a spreadsheet, you know. If you're doing this by hand, it will take a lot more time. Right. So here not, we forgot the initial investment. So let me put that in as well. So I'll just put it here. Initial investment. Okay, so that will be a negative 2 million, right? So you can take a total here as well, a negative 2. Right, so we have the net cash flows. The next step is to use the discount factor at 10% and then try to get the NPV. Okay, so I can just pause a bit, make sure you have all the figures in, and then we can do the NPV. Okay, right. So now you just need to put in your discount factor. At what was the percentage they said? The money rate was 10%. Okay, so that makes life easier for us. Okay, so year one is always 1. The year not is always 1. Year 1 is 0.909, 0.826, 0.751, 0.683. Okay, so now you can take the present values. This multiplied by this. Okay, so just round it up. Right? And let's take the NPV, which is the addition of all of this. All these numbers. Okay, so the NPV is 366,993. You might see small rounding issues with regard to the marking scheme, doesn't matter. Okay, because you have given all your equations. So whatever the spreadsheet is rounding it up to, that should be it. Okay. The reason why there is a rounding thing here is because this used to be the specimen exam for a very long time. Okay. So when we used to do the paper by hand, then when you do this rounding up, we used to, instead of taking 2 decimal places, we just take it to 1 decimal place. Okay, so that's the reason why you will see a small rounding issue. But it doesn't matter because all your formulas are there. The examiner will not penalize you for that. Right? So A part is done, which is the NPV calculation. Now next is you have to do the IRR. Okay, so to do IRR, you need to calculate another NPV. So let me do that. I'll just copy this. Okay, so net cash flows. Give me a minute. Some reason. Okay, this shouldn't be a problem at your exam, guys. I don't know why it's copying it with the formulas and not letting me remove it. So I'll just take the totals. 560,000, 695, 692, 1,351,448, 392,933. Okay, so I have the net cash flows. Discount factor at, instead of 10, just use maybe 20%. Okay, so get the discount factor at 20%. Year one, year not will be 1. Then it will be 0.833. Sorry, 833, 0.694, 0.579, and 0.482. You take the present value at 20%. Just multiply this with this. Okay, so let me put the commas and remove this. Okay, so I have the present values now. If I want another NPV, then I have to take the total. So this in sum of all these numbers. Right? So that will be a negative 78,828. Okay. So now if you need to use the IRR equation, you can do that. IRR equals to the lower rate plus NPV at the lower rate. Okay, so I'll put in brackets. Okay, divided by see if I can only underline that. Yeah. Divided by NPV at the lower rate okay, plus NPV at the higher rate multiplied by the higher rate minus the lower rate. Okay, so we have done this calculation many times before. Okay, so we should be able to just put in the figures that we have to calculate the IRR. Let me see if my pens are working. It's not working. That's the thing. Okay, so it doesn't matter. The lower rate will be 10%. Plus NPV at the lower rate is going to be 366,993. Okay, I'll just put it all in brackets. Okay, so it won't go wrong. 366,993 divided by NPV at the lower rate, which is again 366,993 minus NPV at the higher rate 78,828. Okay, so it has to, you have to have 2 negative signs here. So careful there. So this whole thing should be multiplied by the higher rate, which is 20 minus the lower rate, which is 10. Okay, so I have showed you in previous TRGs how to get IRR in your Cal. So that should give you an answer of 18%. 18%. Right. So that's the IRR. If you look at ROCE, they're asking you to calculate ROCE, accounting rate of return, based on average investment. Okay. So it's like this, right? If you want to calculate ROCE, you need to know the formula, right? So ROCE equals to profit before interest and tax divided by the average investment. Okay. So if you look at the cash flows for the 4 years, you can add them up because we need to take the cash flow, and to make it a profit, you have to deduct depreciation. Okay. So we have the net cash flows, as in the cash inflows for the 3 years that we are interested in. Okay. So what we can do is we can copy this and put it here. Right? So what we'll do, we'll add this up, get the total cash flow. From that, let's deduct the depreciation. That will give us the profit, right? So total cash flow will be the sum of all of these numbers. That is 3,073,000, right? So now from this, let's deduct the depreciation. Now in this case, since we don't have scrap value, the depreciation will be the entire initial investment, right? Because there is no scrap value, right? So finally, I'll put it as a positive figure. The profit that we have to take is this one, 3 million minus 2 million. Okay, so that will be 1,073,000. That's the profit before interest and tax divided by average investment, right? So average investment is the investment, which is 2 million, plus the scrap value divided by 2. Since scrap value is 0, that will just be 0 divided by 2. So the average investment is 1 million. Okay. So if I want ROCE, that will be 1,073,000 divided by 1 million. Sorry, 1 second. What was the profit? Let me check that. 560 plus 696 plus 1. Okay. Oh, yeah. Okay. So one thing I completely forgot. Profit before interest and tax, but this is not average profit, right? So this is the profit when we consider all 4 years. So since we're taking average investment, this also we have to divide it by 4. Okay, so sorry about that. Okay, so let me just divide. Okay, I can't put the division sign. By 4 to get the average profit, right? So that will be this figure divided by 4, which is 250,080, right? So that is what we use for PBIT, 250,018 divided by average investment into 100. Okay, so that will give you an ROCE of 250,018. Okay, so let's just, as a percentage, we're talking about 25%. Okay, so ROCE will be 25%. That's your 3 marks then. Right. So then we move on to the next part, which is entirely to do with discussions, right? So they're saying briefly discuss your findings in each section of A previously and advise whether the investment proposal is financially acceptable or not. Okay. So if you look at the NPV that we calculated, right? NPV, it was positive 366,993. So based on the fact that the NPV is positive, according to the decision that NPV says, you should go ahead with the project. It is financially acceptable. Okay. And most of the time you can also say this NPV is the superior method. So if NPV is saying go ahead with the project, then you can go ahead with it without thinking twice about it. Okay. Then IRR, if you calculate the percentage, it was 18%. Okay. So we need to compare this with the cost of capital. So if you look at cost of capital, it is 10% per year. So again, 18% is more than 10%. So according to the IRR decision also, you should go ahead with the project. And then finally, if you look at ROCE, it was 25%. This company has a target ROCE of 30% per year. So again, if you look at ROCE, 25 is actually less than 30. So based on ROCE, we should actually reject the project. Okay. However, at the end, you can say, although ROCE is asking you to reject the project, NPV is the superior method. Okay, and since the NPV is positive, we will go ahead and accept the project, although the ROCE is below the target rate. Okay, so if you can say that, so basically, if you can say NPV is positive, accept. IRR is more than cost of capital, accept. ROCE is less than target rate. So according to this, you have to reject. That will give you 3 marks. Fourth mark is to say that although ROCE is asking you to reject it, since NPV is the superior method, we have to go ahead and accept the project. That will be the fourth mark. Okay. Right. Then the last part is saying, discuss how the objectives of VIP stakeholders may be in conflict if the project is undertaken. Right. So how will the stakeholder objectives conflict? Who are stakeholders? They can be your employees, they can be your managers, they can be the government, they can be your neighbors, basically anybody who has an interest in your organization. So let's see what their objectives are and how other people will get disturbed by it. Okay. So they're saying here, VIP is a large listed company. Okay. And is evaluating investment projects which has performed well in test marketing trials conducted recently. Okay. And they're talking about this product W33. Okay. So the first stakeholder that we have to remember and think about is the shareholder. So where the shareholder is concerned, if any project has a positive NPV, we have to go ahead and accept it. Okay. So now we are trying to figure out how that objective is going to conflict with other stakeholders. So the first stakeholder we have to consider is the shareholder. Shareholder will say accept W33. Why? Because NPV is positive. It has performed well. If we invest in this project, it will increase or maximize your shareholder wealth. So that is what the shareholder's objective is. Then they're saying product W33 will be manufactured using a fully automated process. Okay. A fully automated process means, guys, you're having robots or something, right? Now, if you have employees in your organization, laborers who are actually working, and you are going to invest in this W33, chances are that they might lose their jobs. Okay. So what is that stakeholder? The employee, his objective is to have job security, right? His objective is to have job security. Now, if you start automating everything, chances are that he will lose his job. So then what has happened? Shareholder is saying accept the project, but according to the employee, he will not want to accept this project because he knows that is a chance that he will lose his job. Okay. So let me just list it down here. You have to write it in proper words. So shareholder will say accept W33. Why? Because NPV is positive. Okay, that means definitely shareholder wealth is maximized. Okay, so that is the shareholder's view. If you look at the employee, okay, he will be reluctant to accept W33 because his job security is compromised due to the fully automated process. Okay. Now, there is another person who will have a problem if employees lose their jobs, and that is the government. Government will have a problem. Why? Because they may be reluctant to go ahead with W33 because it might increase unemployment levels. Okay, so they will have a problem. So you can see employees and the government, they are conflicting with the shareholders. Okay, then they're saying, what is it saying there? Will be manufactured using a fully automated process, and it would significantly increase noise levels in the factory. If noise levels are increasing, a lot of people will start getting involved. First is the local community or the public. Basically, people who live close to the factory, they will have a problem, right? So I'll put it here. Locals may not be happy with the additional noise and may therefore prefer to not undertake W33. Not only that, noise means we're talking about pollution, right? So we have environmental pressure groups, even the government. Okay, so environmental pressure groups and the government, they will also have a problem with this noise pollution. Okay, so local community, environmental pressure groups, plus the government, all of them, they might not be happy with the noise levels. So they will prefer for the company to not go ahead with this project W33. So let me copy this there. Okay, so all of them will have problems with this noise level. Okay, so you can see here very clearly, they are giving you 5 marks for this. So if you mention about the shareholder, definitely you're going to get 1 mark. If you mention about employees and the government and the local community together, you will get the remaining 4 marks. Okay, so here the marking scheme is saying maximization of shareholder wealth. So you identify the fact that the shareholder will want to accept this project because it's maximizing his wealth because of the positive NPV. They give you 2 marks. With regard to automation, employees plus government, their problem, together they give you 2 marks. And anything to do with the noise, they're going to give you 1 mark. Okay, so this is how you will have to structure your answer. So there will be like a word processor, like how they've shown here. You should basically type this in. So you can see that particular question is actually very easy. Based on whatever is there in the text of the initial question, you can just, figure out something. Okay. Right. So that will give you your 5 marks, and the total 20 marks you will get for this particular area. Okay. Right. So the next question in this paper, Frost Company, is to do with a little bit of cost of capital and a little bit of market valuation. So obviously, we just have a few more minutes to go. So we won't have time to do this. So what we'll do, we will do Frost Company, finish off the specimen basically next Monday. And I will touch on a few more areas, right? So far in the TRGs, I have gone through the entire investment appraisal, the entire cost of capital we went through last week. This week, we looked at Forex, foreign exchange risk management. So the only thing I really have to touch on is the interest rate risk management area, right? So next week, I will do Frost and I will go through interest rate risk management. So for you, the last area, that is business valuations. It is very, very similar to cost of capital. Okay, so that's the only area that I have left for you guys to do basically, before you are ready for your exam. So in addition to this, the last thing I have to mention is now at this point, ACCA has released a pre-mock for the June exams. Okay, so you can access it on the ACCA Global website. Please make sure to attempt the pre-mock. They will give you the marking scheme and certain video debriefs, meaning there will be somebody explaining the questions to you as well. So please make it a point to take some time and do that before your exam. It will definitely help. Okay, so we'll do the, make sure that you guys do the pre-mock once you are completely thorough with the entire syllabus. So you can, properly gauge where you stand. So next week, we will do this constructed response plus a few questions in the interest rate risk management area, and we can call it a day, right? So that is it for the day. I will hopefully see you guys next week. Okay, so in case anybody, while you're watching the video or anything, you have any questions, please feel free to reach out to me. I'll be more than happy to help. Okay. Right, guys, that's it for the day.